Hello, beautiful people. Welcome to another brand new episode of the ITU Forex class. In this week's edition, we're actually going to be talking about the relative strength index indicator. Okay, so the RSI is actually an oscillator, or I should say, it's an indicator. It's a technical indicator that's categorized or classed under the oscillator category of technical indicators. Okay, so basically, when we talk about technical indicators like oscillators, for example, the category which the RSI is under, they are indicators which usually from the word oscillators, they oscillate between a certain number of points or levels. Okay, so for example, for the RSI particularly, it usually oscillates from all the way down from the zero reading of the indicators window to a highest reading of 100. Okay, and we're actually going to be talking about what the readings mean and how to use them properly. Okay, that's basically what this class is all about. So when you hear the word oscillators, part of the word means whatever indicator you're looking at or using to study the markets for that particular chart is oscillating between two levels. Okay, so let's quickly add the RSI indicator to the chart, and then we'll talk about how to use it. Okay, because basically a lot of traders, and I mean traders who are just getting started to trading, or inexperienced traders who don't know any better, tend to use the RSI indicator only for finding overbought and oversold areas on the price chart or in the markets. There's no right or wrong way to using the indicator, but that's the method that a lot of traders use it. Okay, but in this class I want to show you that you can not only just use it for that method, but you can also use it to gauge momentum or the strength of a move in the markets. And that's basically what this whole class is about. Okay, so first things first, if you wanted to add the RSI indicator to your charts, where do you find it inside MetaTrader? Okay, so if you're like me and you're using any one of the MetaTrader platforms, maybe MetaTrader 4 or MetaTrader 5, you're usually going to need to go to the navigator menu, and then when you do that, under the Inserts tab, hover your mouse's cursor over indicators, and you're going to be led with this drop down. In the first categories of indicators that you're going to be seeing displayed here, these are actually indicators that you tend to use a lot, so it's just kind of like bringing them close for you to find the indicators easily. But if you don't find it here because you've not added it to your charts before, all you need to do is remember I told you that the RSI indicator, the relative strength index, that's what it means. The RSI, that's what it stands for. So for you to find it, it's under the oscillators category of technical indicators. So just hover your mouse's cursor over the oscillator, and then you're going to find it here. Okay, you can see this is the RSI. It's here under this category. So just click on it to add it to your chart. Now, there are, just like with most technical indicators inside MetaTrader, it has its default settings. Okay, and these default settings, you could just from here just click on OK and add it to your chart and just use it this way. Okay, and in fact, to illustrate my point, I'm just going to click on OK, and this is what it's going to look like on your chart. Okay, but then we're going to actually take it a step further. Okay, and so we're going to customize the indicator a little bit. Not necessarily the period, because the standard period of 14 periods, which means 14 candles of whichever time frames you're using, is what the indicator is using to calculate its readings. Okay, so for this particular example or this particular tutorial, we're just going to stick with the 14 periods, which is okay for now. But one thing I like to do is, for me personally, the line seems to be a little bit thin, and so I like to make it a little bit thicker so that it stands out on my charts. Okay, now remember I told you that when you hear the word oscillate, it means that whatever technical indicator or whatever tool you're using to study the markets is oscillating, or it's moving from one point to another, 2 points basically. Okay, and that's what this is showing to you here. So for the oscillator, for this particular relative strength index, usually by default it's usually going to move from the reading of 0 that's the minimum reading, that's the most minimal reading you're going to get for the indicator, to the max reading of 100. Okay, but if you wanted to do a little bit other than that, you could actually choose to say, okay, I want to use minus 50, for example, or whatever the reading is, for it to be my minimal reading, and then I want to use something like 200 for it to be my maximum reading. You could set it to whatever you want, but we're just, like I told you, going to use the default settings. So conventionally or traditionally, or whichever word you'd want to pick off the two, the way that traders tend to use the RSI indicator is to identify overbought and oversold areas on a price chart. Okay, so when price reaches a certain level, and then usually for the overbought reading, you would want to see the RSI indicator go above the 70 level. The 70 level reading, you see, that's the area where it's going to tell us that, okay, if price goes above, if the indicator is showing us that price is above this area, that's this blue line goes above the 70 area, then price is overbought and it's likely to start moving lower. And then the other one is that if price goes below this 30 area, which is marked by these dotted lines on the indicators window, when the indicators line goes below this area, it is basically telling us that the price of that particular instrument that we are studying is oversold, and so it's likely going to reverse and start moving up. But the thing with this approach to using the indicator, again, this doesn't mean that it works or it doesn't, or like with any other thing in trading, there are times when it's going to work, and there are times when it's not going to work. And that doesn't matter, because if you couple it with proper risk management, then even if it works less times than it doesn't, if you're using proper risk management to actually use it, you're still going to end up being profitable. It doesn't really matter. Okay, so in trading, it's not as if you need to win 100% of the time to make money through trading. You could lose more than you win, but if on average the profits from your winning trades are larger than the losses of your losing trades, then you're still going to end up being profitable. Okay, assuming you have an edge over the markets. So moving on, if the indicator, like I told you from the example, goes above the 70 region, which it did here, and it did here, and it did a couple of times all over here and all of these places. Okay, so if it goes above the 70 reading, it's basically telling us that price is overbought, and so it's likely going to start going lower. And if it goes below the 30 reading, then it's telling us that price is likely oversold and it's likely going to go up. Now, the problem with using the indicator in this fashion is that when the market is trending, remember the market structure for an uptrending market or a downtrending market. For an uptrending market, price is usually going to form higher highs and higher lows. Higher highs, higher lows, higher highs and higher lows. Now, because by virtue of an uptrending market, because price is usually going to make a sustained move in the direction of the predominant trend. So for an uptrending market, this is what it's going to look like, and for a downtrending market, this is usually what it's going to look like. Okay, and so because price is usually going to form this move, there are times when you're going to see very strong trends in the market, and the indicator will be showing you that, okay, price is overbought, but then it's just going to keep moving up and up and up. And so if you're trading without proper risk management, without a stop loss, without all of those safeguards, then using this approach to trade with the indicator is likely not going to be a good method for you to use it for. Okay, and that is just one way to use the indicator. So let's look at a couple of examples here before we move on to using the indicator like we're talking about using it in today's class, which is to use it for gauging momentum in the market and being on the right side of the momentum. So if you look at the charts here, you'd notice that the indicator went above the 70 line here. And remember, I told you that when it goes above the 70 line, that's showing us that price is likely overbought. And so you could see that this, in and around this area, was when the indicator crossed above the 70 line. Okay, and when this happened, basically, if we were just using the RSI overbought and oversold method to just identify when to buy and where to sell, you'd see that, okay, it went above here and then we had a bearish engulfing candlestick somewhere around here, then this would have been a prime example of where to take a short trade setup, place your stop loss, assuming you're using good stop loss and all of those things. And if you have maybe trading with a 1:2 or 1:3 risk to reward ratio minimum, then you would have taken this trade. But then you could see that even though the indicator was telling us that price was overbought, price never really turned down. And so it just kept moving up, and the indicator's blue line, its indicator, the line just stayed above the 70 level, telling us that still price is overbought, but it never really moved down. So if you were trading based on, okay, the indicator just said I should sell because price is overbought, and you are not using proper risk management like a stop loss or a risk per trade or all of those safeguards, then you would have just seen your account get blown, because after you would have taken a trade here without proper risk management, you would have seen the trade just keep going against you over and over and over again, even though the indicator kept telling you that price is overbought, it's overbought, it's overbought. It just kept giving you overbought signals, and it kept going up. Okay, and the same could be said for the opposite. Okay, for an oversold market. If I click on this and we look for an example here, you can see that in and around here, okay, I'm looking for a good example. Or before we even look at a good example of that, let's look at an example of when it did work. Okay, so you can see that we were in a downtrending market in and around here. Price just kept going down and down and down and down, and lower lows, lower highs. You should know this by now, okay? And so at some point, the indicator told us that, okay, it looks like price is oversold, because the indicator's blue line went below the 30 level. And you could see that when it did this, price couldn't go any lower. And so if you're using this method, after you would have seen this bullish engulfing candlestick, either this one here, because the indicator was in and it was below this 30 level and it crossed above it. So when you saw this, you would have taken a long trade setup here at the close of this candle with a stop loss maybe below this area, and then if you are going for a 1:3, then this would have been a clean winning trade for you. So remember, we looked at a trade that didn't work out there, but then this trade gave you 3 times what you are risking on the trade. So if your risk is consistent, meaning you're always risking 1% of your trading account's capital on each trade you take, even though you would have lost a couple of trades there, a couple of wins would pay back for those losses and give you extra profits in the process. Okay, so this does not mean that I'm telling you the overbought or oversold approach of using the technical indicator. This does not mean that it doesn't work. It's just that just like with anything with trading, it's going to get times when it's going to work, and there are also going to be times when it's not going to work. So you need to not just use the method in and of itself, so that whenever you see a signal, you go all in and say, okay, this has to work. No, you need to couple that with proper risk management and proper trading psychology. When we talk about trading psychology, you need to have the right mindset, so that even if the last 10 trades you took following that method were all losing trades, you'd still have the resilience and the discipline to take the next setup, even though you've taken like 10 trades which were all losses, because you understand that there are going to be losses and there are going to be wins, and most times they are going to come in clusters. And so just because you had 10 losing trades in a row doesn't mean that you should abandon the strategy and not take the next trade, because that might just be the trade which will help you to recover a lot of your losses. And in the same vein, if you had 10 wins in a row, that does not mean that you should get overconfident and start betting the farm or risking your entire account's capital on the next trade, because you feel like the next trade is going to be also a winning trade because your past trades were all wins and all of that. Okay, these are all beginner mistakes that you don't want to make. Okay, so however the strategy is, you need to couple it with proper risk management and the right trading psychology for it to work. Okay, so this is the method that a lot of traders use, the RSI indicator, to trade the market. But the method that I'm going to be introducing you to using today is actually called the momentum method, and that is for you to trade when the RSI indicator is telling you that the momentum is in accordance or in line with a certain direction or a certain trend or a certain bias in the market. And that to do that, you need to add the 50 level onto the RSI indicator's window. You see, just like we have the 70 level above here, where if the blue line of the RSI crosses above, that is telling us that price is overbought. And just like we have the 30 level, where if the blue line of the RSI crosses below, it's telling us that price is oversold. We can also add another line to the levels of the RSI indicator, and this is going to be the 50 line. So basically, the way this works is that traders use it to identify when there's a bias in the market in a certain direction. So when the RSI, the blue line of the RSI indicator, when it crosses above the bullish line, the 50 line from below to above it, that is basically telling us that the direction of the trend or the direction of the momentum in the market is bullish. And when it crosses from above the 50 line, the 50 level, which we're adding on the charts right now, to below it, that is telling us that the direction of the momentum in the market, as shown by the RSI indicator, is bearish. So to add this level to your charts, just like you see Somi did, you just double click on the indicators window. It's going to pop up this dialog box, and then when it does that, click on the levels and then add the 50 level. I've already done this, so I don't need to add this line. I'm just going to delete it, and then I've colored this black to make it stand out more. That's the levels, dotted lines and all of that, and I'm going just to click OK. You see, this is how it's going to look like. So using this method, just pay attention to what happens here. When the RSI crossed from below this area to above it here, you could see that price just kept going up. So when this cross happened, you could have taken a trade here because the RSI was telling you that the momentum has shifted from bearish because the blue line was below the 50 line to above it. And so if you had bought here, you would have caught a very good winning trade. Now, does this mean that every time that the blue line of the RSI indicator crosses above the 50 level that it's always going to be a winning trade? Of course not. And that's why risk management is important, because there are times when this is going to work and there are times that it's not going to work. And so for the times when it works, we want to maximize the profits we are able to catch, and for the times when it doesn't, we want to minimize our losses. Okay, so again, look at the previous example. The blue line of the RSI indicator was above the 50 line. And so when price now started shifting from forming the market structure of an uptrending market, or from being in this horizontal range of support and resistance, you can see that when the RSI indicator crossed below the blue line of the RSI indicator, when it crossed below the 50 level, somewhere around here, and let's say you would have taken a short trade here, you would have taken a very good trade, because right after the cross happened, the RSI it signaled to us that price is in a bearish momentum, and so price just kept going down and down and down and down. Okay, so if you're taking a trade here, place your stop loss above here. If you're going for a 1:2 or 1:3, price would have easily hit your profit target. Okay, so this is the momentum method of using the RSI indicator. Looking for more examples, you can see that here the RSI indicator crossed from below. Again, it's going to appear that I'm cherry picking here, but it doesn't really matter, because I've explained to you the basics here. What I mean is, by cherry picking, it's going to appear as if I'm only showing you trades that worked out, but I've also explained to you that they're not going to work out 100% of the time, and that's why risk management is important. Okay, so I'm just showing you examples of this method, but I also want you to have in your mind that it's not going to work 100% of the time, and that's why for the moments or the times when it doesn't, risk management is imperative. If you don't, let me tell you something. You could have a trading strategy that has a 90% win rate, meaning, for example, on average, if you take 10 trades, you're going to win like 9 trades and lose maybe just 1 trade, okay, because of your win rate on average. But do you know that you could have that win rate and still end up losing money? Because let's do the math. Assuming you have a trading strategy that has a 90% win rate, okay, let's do the math. And then it so happens that whenever you win a trade, you're only winning $10, for example. But then whenever you lose a trade, you're losing $90. So let's say on the using the 10 trade example that we have here, your win rate is 90%. So 90% of 10 is 9 trades. So whenever you win a trade, you're actually winning $10. So your gross profit for this example would be $90. Okay? But then what is your gross loss whenever you lose a trade? Remember, whenever you win a trade, you only win $10, but whenever you lose a trade, you lose $90. So in this case, you'd have, when with just that one losing trade, you'd end up losing $90. So when you subtract your gross loss, which is 90 minus $90, okay, from your gross profit, which is $90 also, in this case you would be at break even. So if you had just two losing trades, and let's say your win rate just went from 90% to 80%, with these two losing trades, you would be down 90%. 90%, just imagine. 90% of your account, even though on paper it appears that. This just goes to show you how win rate alone does not tell you the whole story, or it doesn't paint the whole picture. Okay, there are times when you're going to have a trader could have a very high win rate but still be unprofitable, just like I gave you with this example. And there are also times when a trader will have a very low win rate or a modest win rate, which is even maybe below 50%, and still end up being profitable because the average profit from their winning trades are much larger than the average losses from their losing trades. For you to trade with a win rate that is very high and then have an average loss that is bigger than your average profit and still end up being profitable, your win rate needs to be very, very high. And that's kind of trying to force, or not necessarily force, but that depends a lot on you being right. And as you know, with trading, we can't always be right, even if we wanted to, because there's a lot of uncertainty in trading. And so I personally prefer to take the route where I'm going to be wrong. I know I'm going to be wrong most times, but then I structure my trading in a way that even if I'm wrong more times than I'm right, the profits from my winning trades are so big that they are going to not only cover for the losses that I'm going to take, but then they're going to give me extra profits in the process. That's the approach I prefer to take, and I'm fine with the cons of that approach, because that just means that I'm going to have a lot of losing trades, and that's just how it goes. Okay, so without kind of dragging this out for too long, this pretty much brings us to the end of this week's edition of the ITU Forex class. And the main thing I want you to take away from this class is the fact that the RSI indicator, there are lots of ways that traders use them. Okay, some traders, like I gave you an example, use them to identify overbought and oversold areas on a price chart. And so when price goes overbought, they sell, anticipating that the price is going to retrace or mean revert or all of those things. Okay, and there are times when it's going to be oversold and they buy because they assume that price is going to, again, it's going to revert to its mean, and then maybe before even continuing the trend. Okay, that's just one way to use it, and there's no right or wrong way to use it. I just introduced this method of using the RSI indicator to identify momentum in the market and then capitalize on that, which is by using the 50 level of the RSI indicator. And so whenever the line of the indicator crosses above the 50 level, we assume that to be a signal of a bullish market bias or market condition, and so we buy. And when it crosses from above to below the 50 level, we assume the direction or the bias in the market to be bearish, and so we sell. That's one way to use them also, and that's what we discussed about today. Again, some traders use the RSI indicator to identify divergences in the market. So when there's a divergence, when price is making higher highs and higher lows, just like you saw just right here, okay, excuse me, price is making higher highs and higher lows, but then the indicator, which is supposed to do what price is doing, is actually struggling to continue doing this. And then this appears to be a divergence in what price is doing and what the indicator is doing. Some traders use this as an indication of, a signal in the market that price is either going to revert or is going to continue moving in the direction of the trend, and they capitalize on this. Okay, so you could use any one of these methods, but the method in and of itself is not going to be what is going to make you profitable. You need the method along with proper risk management and the right psychology for you to become a profitable trader, a consistently profitable trader. So you need all these three things to marry, and then that's going to help you to have an edge over the markets. So this pretty much brings us to the end of this week's edition of the ITU Forex class. before we wrap up the class, as usual, I'd like to use this opportunity to invite you guys to test out our ITU suite of robots or expert advisors, which are systems that are designed to look for low risk, high probability trading opportunities on your behalf, and then place those trades for you, manage the risk for those trades for you, and help you to start earning while you're learning, and on autopilot while you're out there doing what you want to do with your time. And then the indicators, when you follow our recommendations and set everything up step by step, which we help you do, then it's going to help you to start earning while you're learning how to trade. Okay, so if you're interested, please reach out to us on any of our social handles, and we'll be more than happy to assist you or guide you on how to set everything up step by step and start taking advantage of the opportunity in the forex markets. So once again, thank you for taking time out of your busy schedules to make it to this class. I look forward to seeing you guys in next week's edition of the class. Have a wonderful rest of your week, and God bless you all. Cheers.